If you are collecting Social Security right now, I need you to put down whatever else you are doing and stay with me for a few minutes because three separate money changes are landing on seniors this July, and every one of them touches money that is already yours. One of them can stop your monthly payment from arriving at all if you do nothing. One of them can hand you back up to $6,000 at tax time that most people will never claim because they have never heard of it. And one of them puts a hard ceiling on what you will ever pay for your prescriptions again, but only if you know the program that unlocks it. These are not things that might help you someday. These are real dollars with real deadlines attached to your check, your refund, and your medicine right now. Most seniors have either heard nothing about these three changes or they have heard a headline without ever learning the one specific action that actually captures the benefit. A headline does not put money in your account. The form does, the phone call does, the application does. So that is exactly what I am giving you today, all three in plain English with the precise action for each one. My name is Mason Parker. For over a decade, I have studied retirement benefits, senior tax programs, and the financial rules that affect seniors every single year. Today, I am walking you through all three July changes the way I would walk my own family through them. Hit subscribe right now and turn on the bell. Stay through the second change, especially because there is a connection between that deduction and a separate Medicare cost that almost nobody puts together, and it can make this worth significantly more than the headline number suggests. And in the third change, I will walk through exactly who qualifies for a program that most seniors assume they make too much money for when the actual limit is higher than almost anyone expects. Your deposit, your refund, your prescriptions. Let us start with the one that has the hardest deadline attached to it. The first change touches the way your Social Security physically reaches you. And if this applies to you and you ignore it, your check can simply stop arriving with no warning attached. Here is exactly what happened because this is not a rumor. Executive Order 14,247, signed in March 2025, directs the federal government to modernize how it pays people and to phase out paper checks for federal benefits. The Social Security Administration's operational deadline was the 30th of September 2025, with the full transition away from paper completing by the end of 2026. The paper check is going away, not gradually fading out, being actively eliminated. Who does this actually touch? If your Social Security already arrives by direct deposit, nothing changes for you. You can take a breath, but if you are still receiving a paper check in the mail or you know someone who is, this is the moment to act because once paper checks stop, a payment that has nowhere electronic to go is a payment that does not reach you. I want you to think about who is most likely to still be on paper checks. Very often, it is the oldest seniors, the ones who have done it the same way for 40 years, the ones who do not bank online. Those are also the people who can least afford a missed payment. Option 1 is standard direct deposit straight into your checking or savings account. You need three things in front of you: your bank account number, your bank's routing number, both printed at the bottom of any check, and your own Social Security information. Set it up through your My Social Security account at ssa.gov by calling 1-800-772-1213 or in person at your bank. They do this every day. Option 2, for anyone without a traditional bank account, is the Direct Express card. This is a prepaid debit card the government loads your benefit onto automatically every month, built specifically for people who do not have a bank account at all. Request it through the Direct Express program. Once you have it, your payment loads onto it monthly and you use it like any other debit card at the store, at the ATM, anywhere. There is a path here for every single person watching. The only wrong move is to do nothing and hope the paper check keeps coming, because that is the one thing that is not going to happen. I understand the instinct to resist this. A paper check feels tangible. You can hold it. But here are the facts. A paper check is roughly 16 times more likely to be lost, stolen, altered, or returned than an electronic payment. Mail theft of benefit checks is a real and growing crime targeting seniors specifically. A check sitting in a mailbox can be pulled out, the ink washed off, and cashed by someone who was never meant to receive it. The original recipient is then left proving to the government they never got their own money, waiting weeks for a replacement. While rent is due, electronic payment removes that exposure entirely. The money lands the same morning every month with nothing sitting in a metal box on the street for anyone to take. There is a narrow waiver available for genuinely extreme situations, specifically seniors with no banking access available to them anywhere. The U.S. Treasury allows this exception to be requested, but it is meant for rare hardship cases, not a way to keep a paper check out of preference. For nearly everyone watching, the correct move is to get onto direct deposit or the Direct Express card now, while there is no problem not after a payment goes missing. Here is something worth knowing right now, because it is happening in real time around this exact change. As seniors learn that paper checks are ending, scammers are using that anxiety as an opening. A call arrives claiming to be from the Social Security Administration, stating that your account needs to be verified or updated immediately to avoid an interruption in your payment because of the new electronic requirement. The caller may already have your name, they sound official, they create urgency around a deadline that does not actually exist in the form they describe it. Here is the rule that ends this every time. The real SSA does not call you to verify your banking information. They do not request your account number or routing number through an inbound call. If you initiated the call to set up direct deposit yourself, that is safe. If someone calls you claiming your payment is at risk, unless you confirm your banking details right now, that is the scam. Hang up. Call the SSA back directly at 1-800-772-1213 using the number you find yourself, never a number a caller gives you. Switching to direct deposit is the first step, but once your money is landing electronically every month, knowing whether the account itself is structured safely matters just as much. The joint account risk that hands your savings to a creditor, the FDIC coverage gap most seniors have never checked, the trusted contact setup that prevents a freeze before it starts, all of it is covered with the exact forms and phone numbers in the Senior Money Defense Playbook. The link is in the description below, or scan the QR code on your screen right now to get your copy directly. The second change is not about protecting money you already receive. It is about going and claiming thousands of dollars that may be sitting there right now completely unclaimed simply because the deduction is new enough that most preparers and most seniors have never heard the name, the $6,000 senior bonus deduction. The One Big Beautiful Bill Act signed into law in 2025 created an additional federal tax deduction specifically for seniors. If you are 65 or older by the end of the tax year, you can claim an additional deduction of $6,000 on top of your regular standard deduction. Read that carefully. It is $6,000 per eligible person. A married couple where both spouses are 65 or older gets two of these deductions, $12,000 total shielded from federal tax on top of everything you already receive. Let me put real numbers on it. A married couple, both 67, living on Social Security and a modest pension, comfortably under the income threshold, both qualify. That is two $6,000 deductions, $12,000 of their income. The IRS simply does not get to tax. Depending on their bracket, that is often well over $1,000 back in their pocket, sometimes closer to $1,500. A single retiree, 70 years old, living on Social Security and a small annual withdrawal from savings, well under the threshold for her filing status. She gets the full $6,000 shielded by herself on top of her standard deduction for being 65 and knowing to claim it. Neither of these people did anything complicated. No itemizing, no digging through receipts, no mortgage or charitable gifts required. Here is what makes this one genuinely easy to use. It is an above-the-line deduction. That means you do not have to itemize to get it. You take your normal standard deduction, the simple way most retirees already file, and this $6,000 stacks directly on top. There is a strict income line, and you need to know exactly where it sits. The full $6,000 is available for seniors with modified adjusted gross income up to $75,000 if single or $150,000 if married filing jointly. Above those lines, the deduction begins to shrink, phasing out gradually until it disappears entirely at $175,000 single or $250,000 married. The income that counts is not just your Social Security. It includes retirement account withdrawals, interest and dividends on your savings, and any gain from selling property, all added together. A large one-time IRA distribution in a single year can quietly push you over the line and shrink or erase the very deduction you were counting on. If you are near that threshold and planning a large withdrawal or an asset sale, think about timing before you act. Spreading a large distribution across 2 tax years instead of taking it all at once can be the difference between keeping the full deduction and losing a meaningful piece of it. A little planning before December beats a surprise in April every time. One more eligibility detail. If you are married, you generally need to file jointly to claim this. Filing separately shuts you out. For most couples, filing together is the move that unlocks it. Here's an interaction between this deduction and a separate Medicare cost that almost nobody connects. Understanding it can make this deduction worth significantly more than the direct tax savings alone suggest. Medicare sets your Part B and Part D premium surcharge, called IRMA, based on your modified adjusted gross income from 2 years prior. The $6,000 senior bonus deduction reduces your AGI in the year you claim it. For a senior sitting close to an IRMAA threshold, that $6,000 reduction can be the exact difference between crossing into a surcharge tier 2 years later or staying below it entirely. IRMA surcharges in 2026 range from $81.10 to $576.90 per month above the standard Part B premium, depending on the tier you land in. Avoiding even the first tier saves $973 per year on top of whatever the direct tax savings from the deduction itself already produced. That means for seniors near an IRMAA threshold, this deduction is not just a tax break this year. It can be a Medicare premium shield happening 2 years downstream that almost nobody traces back to this single $6,000 number. How to actually claim it. When you file your Form 1040 or the senior version, the 1040-SR, this is where the deduction gets claimed. If you use a tax preparer, say to them directly, "I am 65 or older. I want to make sure you are applying the senior bonus deduction from the 2025 law for me." If you file your own return, the software will ask your age and walk you to it, but only if you do not rush past that screen. This deduction is available for tax years 2025 through 2028. And here's the move almost nobody knows about. If you already filed a return for a year, you qualified and missed this deduction, you are not out of luck. File Form 1040-X to amend that return, and the IRS can send you the difference. A married couple who never heard of this could be leaving $12,000 of shielded income on the table every single year for as many years as the window has been open. That is not a rounding error. That is real recoverable money simply for checking one box correctly. The third change is for every single person watching who takes a prescription medication because it puts a hard ceiling on a cost that for years had no ceiling at all. Before I get into it quickly, if you have not subscribed yet, this is exactly the kind of change this channel breaks down every week. The ones that arrive quietly with no phone call and no letter explaining what they mean for your specific situation. Subscribe now so the next one finds you in time, not 6 months after it would have helped most. The $2,100 prescription drug cap. Starting in 2025, federal law put a $2,000 cap on out-of-pocket spending for covered Part D prescription drugs in a calendar year. Because that number adjusts for inflation, in 2026, it rises to $2,100. Here is what that means in real terms. Once your out-of-pocket spending on covered Part D medications reaches $2,100 in a year, you are done paying for the rest of that year. Your plan covers 100% of the cost of every covered drug from that point forward. Not a reduced share, all of it. For someone on a $500 a month specialty medication, that is the difference between paying roughly $6,000 a year and paying $2,100 and then nothing for the remaining months. Think about what that means for a family that was rationing pills, splitting tablets, or skipping doses because the refill costs too much. It means they can finally take the medication their doctor actually prescribed in the full amount every time. What counts toward that $2,100 ceiling is your deductible, your copays, and your coinsurance all added together. What does not count is your monthly premium, the cost of simply having the plan. That continues separately. But every dollar you hand the pharmacy for a covered medication moves you toward the cap. Once you hit it, the meter stops for the rest of the calendar year. Now, the part that turns this from a nice fact into real money in your pocket, especially if your income is limited, there is a federal program through Social Security called Extra Help, sometimes called the Low Income Subsidy, that can dramatically lower what you pay for Part D, your premium, your deductible, and your copays, stacking right on top of the $2,100 cap itself. The 2026 income limits are $23,475 for an individual and $31,725 for a couple. The asset limits are approximately $17,220 for an individual and $34,360 for a couple. And your home, your car, and your personal belongings are not counted toward that limit. An estimated 2 million Medicare enrollees currently qualify for Extra Help but have never applied. With Extra Help active in 2026, your maximum copay drops to $5.10 for generic medications and $12.65 for brand name drugs. The Social Security Administration estimates the average annual value of Extra Help at approximately $5,700 per person. Here is something worth checking before you even apply. You do not need to apply at all if you already have full Medicaid coverage, receive supplemental security income, or are already enrolled in a Medicare savings program. The SSA enrolls those groups automatically and sends a confirmation letter, usually purple, before the start of each calendar year. If you believe you fall into one of those categories but never receive that letter, call 1-800-772-1213 to confirm your status. If none of those automatic categories apply to you, the application is Form SSA 1020. Apply online at ssa.gov by calling 1-800-772-1213 or in person at your local Social Security office. Processing typically takes about 6 weeks, and the SSA will send a letter explaining your subsidy level and effective date. The most common reason eligible seniors never apply is assuming their income is too high. Stop right there. The limits are more generous than almost anyone assumes, and they have expanded in recent years. People who were turned down years ago can qualify now. The only way to know for certain is to apply and let Social Security run your numbers. It costs nothing to find out, and if you qualify, it can make your medicine very close to free for the rest of the year. Let me bring all 3 of these home with one clear action for each, because I do not want you to nod along and let them slip away, the way most things people never explain tend to slip away. Change one. If you or anyone you love still receives a paper Social Security check, set up direct deposit through ssa.gov, call 1-800-772-1213, or visit your bank in person. If you do not have a traditional bank account, request the Direct Express card through the program built specifically for that situation. Do this before a payment ever goes missing, not after. And never confirm banking information to anyone who calls you claiming your payment is at risk. The real SSA does not initiate that call. Change 2. The new $6,000 senior bonus deduction is real, and most people will never claim it. When you file, make sure you or your preparer applies it. Say it directly. I am 65 or older. Apply the senior bonus deduction. If you already filed a return since 2025 and missed it, amend with Form 1-040-X and recover the difference. And if your income sits near the $75,000 single or $150,000 married threshold, remember that this deduction can also protect you from an IRMAA surcharge 2 years from now, which makes it worth more than the number on the form alone suggests. Change 3. Your out-of-pocket drug costs are capped at $2,100 for 2026. Check your year-to-date spending with your Part D plan. And if your income is anywhere near $23,475 single or $31,725 married, apply for extra help using Form SSA 1020 at ssa.gov or by calling 1-800-77-21213. Do not assume you make too much. Apply and let Social Security confirm it. 3 changes: your deposit, your refund, your prescriptions, all happening right now in July, all sitting there waiting for the people who actually take the step. The seniors who act on this keep real money. The ones who never heard it lose it quietly, one missed deduction and one unclaimed application at a time. These 3 changes are part of a much larger picture. There is the bank account rule most seniors have never been told about, the Medicare surcharge appeal that recovers money from income you no longer earn, and the Social Security earnings record correction that adds permanently to your monthly check for the rest of your life. I put all of it into the Senior Money Defense Playbook. Every government form named, every phone number listed, every action step written out in plain English so you know exactly what to do and exactly when to do it. The link is in the description below this video and in the channel bio, or scan the QR code on your screen right now to get your copy directly. It is called the Senior Money Defense Playbook. This is general education, not personalized legal or tax advice for your specific situation. Confirm your own numbers with Social Security, with the IRS, or with a trusted advisor before you act. But do not let that stop you from making the call, because the people who do nothing are the ones who lose. Subscribe and turn on the notification bell. Share this with one person over 65 who needs to hear it. There is a very good chance no one has ever told them any of this. I will see you in the next one.